Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
The role of global economic conditions in forecasting gold market volatility. Evidence from a Garch-Midas approach. The role of gold as a traditional safe haven is well recognized, which implies that investors are often attracted to this precious metal due to its ability to offer portfolio diversification and/or hedging benefits during periods of economic slowdown, turmoil in traditional financial markets, increased geopolitical risk or economic uncertainty, and the high degree of risk aversion associated with low investor sentiments. Understandably, an accurate forecast of gold return volatility is of paramount interest to investors and portfolio managers in their asset pricing models, such as gold derivatives pricing, as well as in hedging strategies to mitigate portfolio risks. Not surprisingly, there exists a large amount of literature on empirical finance that aims to forecast gold volatility based on various metrics that capture the uncertain environment of the financial markets and macroeconomy. Against this backdrop, the objective of our current study is to forecast daily gold returns volatility based on a new measure of global economic conditions recently developed by Baumeister et al. 2020 to forecast energy markets. This newly developed measure covers conditions of real economic activity, commodity prices, excluding precious metals, financial indicators, transportation, uncertainty, expectations, weather, and energy-related measures, and hence, encapsulates the various measures capturing the position of risk in the overall world economy, as discussed above. For forecasting gold market volatility, given that the index measure of global economic conditions is available at monthly frequency, and given that we want to forecast gold market volatility on a daily basis, to avoid the loss of information that would result from averaging the daily volatility to a lower monthly frequency, we rely on the generalized autoregressive conditional heteroscedasticity (GARCH) variant of mixed data sampling, Midas, i.e., the Garch-Midas model. Note that the decision to forecast gold market volatility at the daily frequency is not only due to the underlying statistical reason of providing more accurate measures of volatility, but because high-frequency forecasts are indeed more important for investors in terms of making timely portfolio decisions. In addition, with gold market volatility also capturing global economic uncertainty, which affects the slow-moving real economy, accurate forecasts of the same would help policymakers forecast the future path of low-frequency domestic real activity variables using methods of nowcasting, and thus come up with appropriate and early policy responses to prevent a possible recession. Even though the main focus is on forecasting gold volatility using the Global Economic Conditions Index, we also forecast the volatility of 4 other precious metals, silver, platinum, palladium, and rhodium, using this index. In addition, we forecast the volatility of the returns of all 5 metals, gold, silver, platinum, palladium, and rhodium, using 5 alternative, but narrower, measures of global economic activity, primarily associated with output, that have been used in the literature, for the sake of comparison. To the best of our knowledge, this is the first attempt to forecast daily volatility of precious metals using a broad index of global economic conditions based on a Garch-Midas approach. Table 1. Summary statistics. The summary statistics of the data series are given in Table 1. The mean values of the return series range between 1.43 times 10 to the minus 4 and 3.26 times 10 to the minus 4, corresponding to platinum and palladium, respectively. However, gold and silver returns are the least and most volatile, respectively, among the precious metals investigated, as suggested by the standard deviation. Also, confirmed by the coefficient of variation, the same two metals' returns are the least and most widely varying. Gold and rhodium returns are positively skewed while the remaining precious metals are negatively skewed. All the returns are leptokurtic as expected of returns series. Economic activities, on the other hand, are found to have a mix of positive, GECON, RCPF, RSCF, and OECDIP, and negative, GSPF, and KINDX, averages. While KINDEX is the most volatile economic activity proxy for the period under consideration, RCPF appears to be more widely varied than any other economic activity proxy. While all the economic activity proxies are leptokurtic, we find all, except GSPF, to be negatively skewed. In the preliminary analysis, we test for conditional heteroscedasticity using a formal volatility test, the autoregressive conditional heteroscedasticity (ARCH) test, and serial correlation using Q statistics and Q2 statistics for autocorrelation and higher-order correlation, respectively. These tests are conducted for all variables at lags 5, 10 and 20. And the results are presented in Table 2. All the variables, both metal returns and economic activity proxies, exhibit ARCH effects. This is expected as it is often found to be a characteristic feature of high-frequency data. Consequently, the significant ARCH effect suggests the appropriateness of a GARCH-based model framework. There is also evidence of serial correlation in all the metals' returns, except platinum at lag 5, and all the economic activity proxies, except RCPF at the 3 specified lags. However, higher-order autocorrelation is statistically significant for all the variables. Given the above-mentioned characteristics and the frequency mix of the metals' returns and economic activity proxies, we adopt a framework that incorporates the mixed data sampling technique into a GARCH framework, GARCH-MIDAS. Table 2. Preliminary Analysis 4. Results and discussion. As previously stated, the GARCH-MIDAS model framework is adopted for this study. We proceed to ascertain the predictability of precious metals returns based on the Economic Activity Index. We consider gold returns and all 6 economic activity proxies for the main estimation, Tables 3 and 4, while the returns on silver, platinum, palladium, and rhodium are considered for robustness, Table 5 and Appendix Table A1. We use the full data sample of gold returns to estimate the parameters of the GARCH-MIDAS model in a bid to establish predictability and thereafter split the data sample into 2 equal halves for robustness of predictability and forecast evaluation. Thus, the out-of-sample forecast performance of the various measures of global economic conditions is evaluated. In essence, we first present the impact of each of the economic activity proxies on gold return volatility, and thereafter we determine the measure that best forecasts the volatility of gold returns based on the root mean square error, RMSE. 4.1. Predictive power of economic activities for gold volatility. The estimates of the parameters of the GARCH-MIDAS model are presented in Table 3. They include the unconditional mean for gold returns, the ARCH and GARCH terms, and, respectively, in the short-term component, the sum of weighted rolling window exogenous variable, indicating the predictability of the monthly economic activity on the daily gold return volatility, adjusted beta polynomial weight W, and the long-run constant term M. We find across the economic activity proxies, statistically significant and, with the latter indicating high degrees of volatility persistence, and the sum of both being less than 1 indicating a mean reverting property. This result indicates that shocks to gold returns are unlikely to be permanent, though they may linger for a longer time period before fizzling out. This stance is the same across the economic activity proxies considered. We also find statistical significance and non-significance in the cases of and M, respectively, across the economic activity proxies. The estimated beta weight is significant in all except RSCF and KINDX. Table 3. Predictive power of economic activities for gold volatility. The slope parameter in the Midas filter specification, which gives an indication of the predictability stance of the corresponding economic activity employed, is negative GECON, RCPF, and RSCF, and positive GSPF, KINDX, and OECDIP, and statistically significant in all except KINDX employed on the full data sample. A significant coefficient indicating the predictive power of KINDX, as well as other economic activity proxies. For gold price volatility is however observed when 50% of the data sample is used, with negative predictive values in the case of GECON and RSCF. These results indicate that the predictability results may be sensitive to the chosen data sample. Lower economic activities, GECON, RCPF, and RSCF, and GECON and RSCF, are found to increase gold return volatility when the full and 50% data samples, respectively, are used. Consequently, the positive or negative nexus between gold return volatility and economic activity is dependent on the choice of economic activity employed, as well as the choice of data. Nonetheless, the outcome seems to suggest that not all the various measures used for global activity truly measure it properly. It is expected that as global activity improves, trading in gold should fall as it is a safe haven. See Bauer and McDermott, 2016. So volatility should fall, which is what is consistently seen for the two data samples using the global activity measures GECON and RSCF. Put differently, if gold is considered a safe haven, lower economic activity would increase trading in the metal and hence volatility should rise. However, some other economic activity indices such as GSPF, KINDX, and OECDIP, which consistently turn up positive relationships with gold returns, appear to see the metal from the perspective of any other financial asset where any improvement in global economic activity is seen as a reflection of improved financial market trading activities. Among other things, which ultimately give rise to higher volatility, our results are generally comparable to those of Fang et al., 2018, who argue that economic policy uncertainty improves the forecast of gold variance, but provide a nice addition through their reliance on a large set of global economic activities, Baumeister et al., 2020, and a focus on various precious metals, see section 4.3. They also add to the growing literature that uses only one variable, e.g., silver volatility, as in Burri and Jalk, 2019. Or risk aversion, as in Demerer et al., 2019, while predicting the volatility of gold. 4.2. Out of sample forecast evaluation, we proceed to examine the forecast error of the Garch-Midas model relating gold price volatility to various economic activities. Here, the root mean square error, RMSE, is used, with values closer to zero indicating higher precision and better performance, when confronted with two or more contending models. This would form the basis for determining the most precise economic activity in the prediction of gold price volatility. We perform the out-of-sample forecast evaluation using 50% of the data sample. Based on 3 forecast horizons, 60, 120 and 180 days ahead out-of-sample forecast horizons. See Table 4. In the out-of-sample forecast evaluation, the least RMSE is recorded when the GECON measure is incorporated as the exogenous variable in the Garch-Midas model framework, and this proxy is the most preferred for gold return predictability using the 50% data sample regardless of the forecast horizon. This further attests to the preference for GECON in the in-sample predictability results where the proxy shows gold as a safe haven. Consequently, forecasting with this attribute of the gold market improves the forecast performance of the Garch-Midas framework in producing accurate estimates for gold market volatility. As with the predictability results reported in Table 3, next to the GECON measure, in terms of the out-of-sample forecast performance, is the RCPF measure, which also supports the safe haven property of the gold market. Given the need to understand future events through the information available in data, the GECON measure, closely followed by the RCPF measure, presents the most suitable forecast regardless of the specified forecast horizon. Therefore, it is not out of place to conclude that any predictive model that accounts for the safe haven property of the gold market produces better forecast results. 4.3. Additional analysis. By way of extension, we replicate all the analyses for the other precious metals, silver, platinum, palladium, and rhodium. 2 objectives are of interest here. First, like the gold market, we attempt to examine the role of the various measures of global economic conditions in predicting the return volatility of other precious metals. Second, we compare the forecast results of these measures with those obtained for the gold market. The RMSE results are presented in Table 5 for the 60, 120 and 180 days out of sample periods. The predictability results are presented in the appendix and, like the gold market, the results are mixed. For the out-of-sample forecast evaluation, Table 5, the RCPF measure of global economic conditions is found to consistently outperform the other global economic activity proxies across the 3 out-of-sample forecast periods in the case of silver and platinum, having the least RMSE values in comparison with others. For palladium, while the RCPF measure is still preferred in the 60 days out-of-sample period, the GSPF measure outperforms the others when higher out-of-sample periods, 120 and 180 days, are considered. Other measures such as the KINDX and RSCF equally perform well in the 180 days out-of-sample forecast period. For rhodium, the RCPF measure performs best in the 60 and 120 days out-of-sample forecasts, while the RSCF and KINDX measures are both found to have the least RMSE values for the 180 days out-of-sample period. Overall, the results show that, while the performance of the global economic indices is mixed across the precious metals considered, it appears that RCPF, in addition to predicting the volatility of these precious metals, does so preferably better than any other economic activity proxy considered in this study. In other words, on average, the RCPF measure may be a suitable predictor of the analysis of the role of global economic conditions in the predictability of the return volatility of the selected precious metals, other than gold. This is somewhat similar to the outcome of the forecast analyses for the gold market, where the RCPF measure closely follows the GECON, which is the preferred proxy for global economic conditions for this market. This outcome further strengthens our argument that the choice of the proxy for global economic conditions has a role to play in the predictability of return volatility of precious metals. Comparatively, and judging by the RMSE values, The global economic conditions forecast the return volatility of the gold market better than other precious metal markets regardless of the choice of measure of global economic conditions. Since the GECON measure, which produces the best forecast for gold, supports its safe haven property, we are more inclined to conclude that any forecasting model that accounts for this feature will produce better forecast results than those that do not. 5. Conclusions. The role of gold as a traditional safe haven is well established in academia as well as in the financial media, which implies that investors use this precious metal for portfolio diversification and/or hedging during periods of economic slowdown, turmoil in traditional financial markets, increased geopolitical risk and economic uncertainty, and the high degree of risk aversion associated with low investor sentiments. Given this, we try to forecast gold returns volatility based on a new measure of global economic conditions which encapsulates the various dimensions of the above-mentioned risks. We apply the Garch-Midas model to forecast daily gold volatility based on a monthly index of global economic conditions. Notably, we compare the gold market results with volatility forecasts of silver, platinum, palladium, and rhodium, and consider alternative narrower measures of global economic activity in forecasting the volatility of these precious metals. We find that gold volatility responds to global economic conditions, albeit with mixed outcomes. Importantly, the measures of global economic conditions that support the safe haven property of gold produce better forecast results than other measures of global economic activity that oppose the safe haven property. Further results involving other precious metals also produce mixed outcomes, but comparatively, the global economic conditions seem to forecast the volatility of gold better than the volatility of other precious metals. Our results have important implications for both investors and policymakers. In particular, using the information content of the broad measure of economic conditions around the world, investors could accurately forecast gold returns volatility and that of other precious metals, which, in turn, would help them design optimal portfolios to mitigate the risks associated with other financial assets. Given that gold market volatility captures economic uncertainty, accurate forecasting would provide information about the future path of the economy contingent on the evolution of uncertainty, which can then be fed into mixed frequency models to produce forecasts of wide ranges of low-frequency metrics of domestic economic activity, and thus design appropriate policy responses to prevent the possibility of economic downturns. As part of future research, it would be interesting to use the new measure of global economic conditions to forecast crude oil volatility, with the analysis justified by the fact that crude oil is the highest traded commodity in the world market. In this study, we examine the role of global economic conditions in forecasting gold market volatility using alternative measures. Based on the available data frequency for the relevant series, we adopt the Garch-Midas approach, which allows for mixed data frequencies. We find that global economic conditions contribute significantly to gold market volatility, albeit with mixed outcomes. While the results lend support to the safe haven properties of the gold market, the outcome is influenced by the choice of measure of global economic conditions. For completeness, we extend the analyses to other precious metals such as silver, platinum, palladium, and rhodium and find that global economic conditions forecast the volatility of gold returns better than other precious metals. Our results are robust to multiple forecast horizons and offer useful insights into plausible investment choices in the precious metals market.
Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.